Welcome to the Climate Policy Initiative webinar on the Global Landscape of Climate Finance 2019. This webinar will be presented by CPI analyst Rob Macquarie, Chavi Mittal, and Cooper Weatherby, followed by an introduction from Dr. Barbara Buchner, Executive Director of Climate Finance at CPI. The format will be a half-hour presentation, followed by a question and answer session. All attendees will be on mute, but during this time, you're welcome to submit questions by typing them into the chat box in the lower right-hand corner of your screen, and we'll address them after the presentation. This webinar is being recorded and will be available online at the CPI website in the coming days. And now, I'll turn it over to Barbara.
Great. Well, thank you so much, Carolyn, and thank you so much, everyone, for joining us today. Let me just give you first a quick word on who we are at Climate Policy Initiative and what we do. So CPI is an advisory and analytical organization. We work with governments, financial institutions, and businesses to drive economic growth while addressing climate change. And we work across 6 offices around the world: in Brazil, in India, in Indonesia, Kenya, the US, and the UK. And today, we will present our flagship State of Finance publication, The Global Landscape of Climate Finance, with the most comprehensive information available about the scale, the key actors, the instruments, the recipients, and the uses of finance supporting climate change mitigation and adaptation. This year, we provide a full comprehensive update of our global climate finance estimates with a 6-year trend analysis. Just for context, previous editions of the report have served as the basis for Intergovernmental Panel on Climate Change Report's chapter on climate finance and the UNFCCC's biennial assessment and overview of climate finance flows, and as a background for G7 statements. Let me also acknowledge that this report is made possible by the support from the German Federal Environment Ministry's International Climate Initiative, ICI. So let me move on to our agenda. And very quickly on the agenda, what we'll do today, we'll start looking first at the scope of finance flows, and then we'll go into the various breakdowns of the total landscape of climate finance globally, including the public and private actors, the instruments, the uses, and the sectors, and the geographical splits. Please note that we will provide investment totals in US dollar terms. We'll follow then with a brief discussion on opportunities to scale climate finance based on the trends we're seeing, both in the data and drawing also on CPI's other research. And then we'll end with some time for Q&A and look forward to your input there. So let me now hand it over to my colleague Chavi, who will take you through the scope of our report, the headline figures, and the discussion around private and public actors. And so enjoy, everyone. Thank you. And over to you, Chavi.
Thank you, Barbara, and welcome everyone to the webinar. Let me first take you through our headline numbers before going into details. In terms of annual 6-year trend, we for the first time see the impact of Paris Agreement in our numbers. A surge in policy and commercial commitments in the years that followed the accord meant that climate finance flow crossed the $500 billion mark for the first time in 2017 and 18. Annual flows rose to $579 billion on average over the current 2-year period, representing an increase of 25% or $1.16 billion from 2015 and 2016, our previous landscape numbers. The landscape reports 2-year averages to kind of smooth out annual fluctuations in the data. Indeed, climate finance flows reached a record high of $612 billion in 2017, particularly driven by renewable energy capacity additions in China, US, and India, as well as increased public commitments to land use and energy efficiency. This was followed by an 11% drop in 2018 to $546 billion, which will come, for which the reason will come out later in the next slides. Moving on to the next slide, however, it's important to note that there's still a significant gap that exists between existing investments that we observe and what's really needed for a successful low-carbon transition. As shown here in this graph, there is a huge gap when you see $579 billion versus what is the real need of $1.6 to $3.8 annual need for supply-side energy system investments identified by the IPCC report. Also, we need to understand, while there's no definite estimate of investment required to achieve global climate goals, it's very clear that, these incremental increases in climate finance will not be sufficient to deliver on these objectives, and a change of gear is really needed. Moving on to, what exactly does the landscape really track? In defining the scope of our work, it's very useful to start with the objective, which is to kind of provide a comprehensive overview of new annual flows into low carbon and climate resilient interventions. This means that we track financial commitments, that is investments which are almost reaching financial closure of the project rather than actual disbursement of those funds. It also means that we are focusing primarily on primary transactions, ideally at project level, and this can include investments in new productive assets or activities, such as capacity building or support for policy development. It is also important to know that we're kind of aiming for a non-double counted aggregate figure for climate finance flows, and this has really a significant effect on the way of what we track. So for instance, what we don't track is risk mitigation instruments such as guarantees or insurance in the total flows. We also do not include policy-induced revenue support such as feed-in tariffs. We also exclude secondary market transactions such as non-project bonds, mergers, and acquisitions. Also investments in manufacturing and R&D, because such investments are recouped through the project investment costs that we track. We also exclude all power generation that is fossil fuel based, even low carbon and relatively energy efficient projects. Moving on to the next slide. Our endeavors in each of the landscape cycle is to keep improving our climate finance flow coverage, and this year really was no exception too. The current landscape benefits from expanded data sources, which were not included in the previous version of the landscape, and these includes data on charging points for electric vehicles, supplementing EV retail sales, both of which we kind of gained from working closely with International Energy Agency. Also, data set from our partners, Convergence, had some coverage on blended finance projects too. The IG Global data was also used to add public and private transport infrastructure, waste and wastewater projects. We also closely collaborated with the Climate Bonds Initiative, and we have information how the use of the proceeds from green bond issuances, which will go in later in details. And finally, our regular DFS surveys continues to increase our granularity because we kind of keep receiving more project level data from different institutions as well. And these new data sources account for almost 1/4 of the increase in the climate finance, with the other 3/4 coming from growth in areas that were tracked in our previous landscapes. Let me now quickly take you an overview of the Sankey diagram before providing a breakdown of each of the individual elements. The Sankey kind of aims to provide a snapshot of the organization acting as sources or intermediaries of climate finance, the mix of financial instruments that are being used, and the types of activities being financed. As you see, capital sources intermediaries are categorized into public and private categories. Private finance flows come really from 5 categories, which is commercial financial institutions, corporations, private equity, venture capital and infrastructure fund, then households and institutional investors. On the other hand, public finance flows through government budgets and their agencies, climate funds, and DFI, development financial institutions, comprising of national, bilateral, and multilateral financial institutions. Next are the instruments used to raise finance, consisting different forms of debt and equity, at project level or straight onto entities' balance sheets, and at concessional rate or market prices. We also include grants. So every financial flow is classified for its use towards meeting climate objectives, broken down into mitigation, adaptation, and dual benefits projects. Dual benefits are projects which are targeting both mitigation and adaptation objectives. And the chain concludes in the sector where this finance is actually being spent, such as renewable energy, transport, agricultural land use, and others. And the number here represents an annual average over 2017 and 2018. We'll be going into annual differences shortly. Beyond the Sankey, we will also be going into more detail on the geographies too that are not really reflected in the Sankey. Now for detail, we first look at the commitments by private and public sources and intermediaries. That's the first section of the Sankey. Public and private commitments continue to rise, with private sector still providing most of the climate finance. Climate finance provided by public sources increased by 18% from $215 billion annually in the previous period to $253 billion in 2017 and 18. And the overall share of the total climate finance provided by public sources fell slightly to 44% from 46% over the previous landscape. Also, private actors provide an average of $326 billion per year, which is a 31% increase over the previous landscape. And this increased private sector activity is an indication of maturing markets, particularly renewables, requiring less public support to drive investments now. Let's go now into each detail in each of these actor categories. Let's look at the public actors first. So national, bilateral, and multilateral development financial institutions accounted for almost 84% of the total public finance, and their annual commitments increased from $194 billion previously to $213 billion in the current landscape. Within the DFIs, national DFI remains the largest provider category for climate finance among DFIs. But unlike the previous landscape, when their commitments almost doubled from 2013-14 numbers, national DFI flows have remained steady at an average $132 billion in the current landscape. In fact, if you see if after a spike in 2017 or retrenchment among some larger institutions kind of led to this decline in 2018, which is mainly due to regulatory tightening and shifts in some domestic policies towards deleveraging and financial risk management, particularly in the East Asia and Pacific region, and also attributed to a global economic slowdown in 2018. Moving on the bilateral and the multilateral DFIs, which continue to increase their commitments by almost $7 billion and $11 billion, respectively. Going forward, we also expect this trend to continue. In fact, in the recent UN Climate Action Summit, the International Development Finance Club, IDFC, which includes all bilateral, national, regional development banks, committed to mobilize almost $1 trillion by 2025 for climate action. And we've also seen a lot of MDBs kind of renewing their commitments. Similarly, tracked climate finance from government budgets and agencies more than doubled to $37 billion, accounting for almost 15% of the public flows. And this was primarily due to increased government spending on EV grants and incorporation of new data sets as well into the landscape, tracking which now covers both EV charging infrastructure investments and a subset of bonds issued by regional and municipal governments. Also, multilateral climate funds also increased their annual financing to $3.2 billion, primarily led by increased spending, which was primarily driven by Green Climate Fund and the Green Environment Facility. Moving on to the private side, private actors provide on average $326 billion in climate finance, an increase of 31% from 2015-2016 numbers. Corporations still account for the most private investment at $183 billion per year, or 56% of the total private flows. But we also saw commercial financial institutions playing a very important role than ever, increasing financing by 51% compared to the previous landscape. So, a more prominent role for banks is one aspect of a broader move within the financial markets into sustainable sectors, particularly renewable energy, which receive almost 93% of banks' climate finance as well in the current landscape. Financing from institutional investors and smaller funds also increased more than threefold to $9 billion, and venture capitalists and the other category, the private equity and infrastructure funds, also more than doubled as well. While these flows really remain much smaller than those when we see in comparison with corporations and banks, the rapid increase kind of reflects continuing maturity and lower perceived risk in renewable energy markets, and greater willingness among these investors to kind of finance projects in their early stages. Households also increased their climate-related consumption to $55 billion, a rise of 32%, with increased spending on EVs and deployment of small solar panels and small water heaters as well, signifying greater awareness of sustainable alternatives in energy and transport. I will now hand over my colleague Cooper to provide more detailed breakdowns by instrument, sectors, and geographies. So over to you, Cooper.
Great. Thanks, Chavi. I'll first discuss the breakdown of climate finance by financial instrument and then go into some trends in uses for both mitigation and adaptation finance. So first, let's respect to instruments. Most climate finance in 2017 and 2018 was raised as debt, which includes balance sheet market rate debt, project level market rate debt, and low cost or concessional project level debt. These three types of debt combined accounted for 66% of total tracked climate finance, which came out to $380 billion annually. Market rate debt specifically through either project or corporate finance was the largest individual instrument used to channel climate finance, came out to $303 billion a year. A little bit less than a third of that market rate lending was financed on corporate balance sheets, while the other 70% was project level financing. Climate finance from low cost project level debt was about a fifth of the market rate total at $64 billion annually, and almost entirely provided by public sources. I believe the figure on that was 98% from public sources. Equity investments were the next largest category after debt. They accounted for 29% of total climate finance flows, or $169 billion annually. 3/4 of those equity investments were corporate balance sheet equity, the rest of that being project level equity investment. And finally, grants now represent a larger share of climate finance than ever before. Public actors are using grant finance to build strong enabling environments and undertake demonstration projects for sustainable investment across a range of sectors. Annual grant finance averaged $29 billion, or 5% of total global finance flows in 2017 and 2018, which is an increase of over 50% since the previous landscape, and actually more than double the value of grants tracked in the 2013-2014 period. Turning to end uses and sectors, climate finance flows to two primary use categories, mitigation and adaptation. Xavi already provided some helpful background on what those mean. Some sectors can fall under either use category, and some financing supports projects with dual benefits that advance both adaptation and mitigation objectives. So the vast majority of tracked finance continues to flow towards activities for mitigation. So you can see here 93%, or $537 billion annually, is flowing towards mitigation. Much smaller amounts going towards adaptation. That being said, we have seen adaptation increase fairly rapidly in recent years. So moving on to break this down a little bit more. Okay. Adaptation financing is still falling well short of the required investment. So you can see estimated adaptation needs from the Global Adaptation Commission here come to $180 billion a year. However, the current funding that was raised in the 2017-2018 period was just about a sixth of that at $30 billion a year. Tracked finance is also below the $50 billion a year that non-Annex 1 countries will need to achieve their nationally determined contributions according to the UN Environmental Program. So these figures call for an urgent increase in finance for adaptation projects and long-term climate resilience as we think about future infrastructure and development needs. For mitigation finance, renewable energy remains by far the largest sector. Renewables finance hit an all-time high of $350 billion in 2017, reflecting an increase in capacity additions, particularly in China, the United States, and India. The annual mitigation average for 2017-2018 was $336 billion. While renewables are still the largest absolute destination for mitigation finance, financing for low-carbon transport is actually growing more quickly. Transport finance increased from an annual average of $92 billion previously up to $140 billion in the current landscape. We're seeing that rapid growth in both the public and private sectors too. Now, energy efficiency has grown modestly. Finance for land use more than doubled from $4 to $11 billion, but in absolute terms, both of these sectors continue to lag well behind the levels of investment required to enable the transition to a low-carbon, climate-resilient economic future. So the focus continues to be on renewable energy, and there's need for investment to diversify across other sectors. So let's put the renewable energy investments I mentioned in the previous slide in perspective. Finance for electricity from renewables exceeded fossil fuel power generation finance in 2017 and 2018, according to the International Energy Agency. We're seeing average annual finance for renewables coming in at more than 2.5 times the total for fossil fuel generation. So that would appear to be a positive trend that continues in this edition of the landscape. That's a useful comparison, but it's not the whole picture. If we include investment in fossil fuel supply infrastructure, as you can see in the three lighter gray bars in the chart, things look very different. Average annual finance for fossil fuel supply infrastructure at about $800 billion is more than triple clean energy finance. And when I say fossil fuel supply infrastructure, that includes investments in upstream and downstream oil and gas, coal mining and related infrastructure, as well as that original fossil fuel power generation figure that I initially referred to. So combining all of those, if funds continue to flow to fossil fuel projects at such a massive scale, we'll lock in high carbon assets likely to become stranded over the course of a successful low carbon transition. So it's incredibly important to continue efforts to phase out those investments in all of these aspects of the fossil fuel supply chain, and not just in power generation. All right, let's talk about how public and private finance for mitigation differ. Private mitigation finance is concentrated in renewable energy generation and low carbon transport. So renewable generation made up about 85% of private finance for mitigation. Low carbon transport accounted for the other 14%, and the final 1% of that private mitigation investment figure is split between a whole bunch of sectors. Public mitigation finance, on the other hand, is a little bit more interesting to break down because it's distributed more evenly across various sectors. So low carbon transport accounted for the largest plurality of total public mitigation finance. It came out to 44%, or $94 billion annually. Finance for the transport sector has increased 15% since the previous landscape in 2015 and 2016. The growth we're seeing in transport underlines growing public sector commitments to pursue low carbon transport as a key component of climate smart investment strategies. So there's a shift in institutional focus that's going on there that's important to track. After transport, renewable energy generation accounted for the next largest share of public mitigation investment at 28%, and public energy efficiency investment came in third with 16% of the total. Moving on to discuss adaptation finance. Almost all adaptation finance tracked in this year's landscape was funded by public actors, only 2% sourced from private actors. Nevertheless, the increase in adaptation finance since 2015-2016 has been accompanied by a greater balance in spending across sectors. Three sectors, water and waste, land use, and disaster risk management, each receive between 20 and 35% of the total, whereas in previous years, adaptation finance was dominated by the water and waste sector. Public financing for disaster risk management projects has grown the fastest recently, perhaps linked to more frequent and severe extreme weather events in those years. So these numbers are just a partial estimate. Our tracking process faces certain challenges in applying standardized definitions and ensuring consistent reporting practices, especially for adaptation finance. That being said, public development finance institutions are working to continue to improve methodologies and fill gaps, and we see potential for further progress as we begin to look toward the next landscape in 2021. So that covers the major points on instruments and uses for climate finance. I'll now hand off to Rob to cover some geographic trends and walk us through our overall conclusions and recommendations for the 2019 landscape.
Thanks very much, Cooper. So while geographical classifications aren't in our main Sankey diagram, we do track the geographic origin and destination of climate finance flows. And we find that 76% of finance was raised and spent in the same country, which is a similar proportion to what we've seen in previous years. The trend further underlines the importance of strong national policy and regulatory frameworks to encourage domestic investment. And another continued trend is that climate finance was sourced almost equally from OECD and non-OECD countries. However, most climate finance flows to projects in developing countries, with 61% going to non-OECD countries. $72 billion flowed from OECD to non-OECD countries in 2017 and 18. That's a 60% increase from the previous landscape. And annual flows between developing countries increased from $11 billion in 2015-16 to $19 billion in the current landscape, indicating stronger South-to-South cooperation in climate action. By region, East Asia and the Pacific remains the primary destination, accounting for $238 billion per year, or 41% of all flows. And that's mostly thanks to China, which is again the largest originator and destination country. But the fastest growth was in finance for projects in Oceania and in the Middle East and North Africa, with increases from 2015 and 16 of 165% and 78% respectively. However, finance fell in Japan, South Korea and Israel, and for Western Europe it remained essentially flat. Private finance was dominant in the Americas. In that category we include North America as well as Chile, joining up the Western Hemisphere countries that are in the OECD. And the same goes for Oceania and Japan, South Korea and Israel, while Western Europe, East Asia and the Pacific and South Asia had an almost even split between private and public finance each. But in all other regions, public sources were the main providers of climate finance. That reflects a continued dependency on public funds among developing and vulnerable territories for sustainable growth. So while we've improved coverage of actors and sectors in this edition of the landscape, there's still work to be done in tracking climate finance. Important gaps in our dataset still include domestic government expenditures and private investments in energy efficiency, transport, land use and adaptation. So efforts to fill these gaps are taking place. And in particular, there's an increasing number of country and sector-specific studies that capture the unique circumstances of their study areas. And CPI participates in networks like the OECD's Research Collaborative on Tracking Finance for Climate Action, and we also convene a climate-aligned finance tracking group to bring together stakeholders to work on these areas. So finally, I'm going to cover some of our recommendations for addressing the finance gap that we see. It's worth reminding at this stage that while there are several positive trends in the report, there is still a huge gap between actual flows and investment needs. And increasing climate finance commitments alone is not enough. It's more crucial than ever to phase out investment in the fossil fuel supply chain and in other harmful brown activities, because continued financing for these activities increases the chance of missing abatement targets, it magnifies financial transition risks related to stranded assets, and on the whole contrasts starkly with the goals set by the Paris Agreement. So as well as transforming the energy system, investment needs to shift away from high carbon assets and towards green alternatives in land use, transport, water and industry. So in the report we identify several opportunities to achieve that. First of all, governments need to continue raising their level of ambition. This means creating national climate plans and allocating resources to ensure that those are implemented. It could involve explicitly adjusting the mandates of national institutions to include reference to the Paris Agreement and the Sustainable Development Goals. Regulators also have a key role to play by refreshing their frameworks to acknowledge climate risks. Second, public and private actors need to coordinate to rapidly scale up finance in sectors beyond renewable energy generation. All financial actors will need to increase their investment in energy efficiency, adaptation and land use. Public institutions and philanthropic foundations have an important role in facilitating private finance through both regulation and blended finance tools. But in addition, we need to see research and development of new technologies, rather than investment targeting only low-cost marginal abatement opportunities, so that we can enable pathways to net zero. And tracking progress towards that goal will require better, deeper data on climate-related R&D spending. Thirdly, all financial actors should seek full alignment with the Paris Agreement across all of their operations. So that includes, but is not limited to, their loan portfolios. In the case of public institutions, it means strategic collaboration with governments, refreshed investment pipelines, and reassessment of risk management, asset valuation, and capital allocation practices. Meanwhile, private actors must pursue alignment by moving capital away from high carbon activities towards the sustainable sectors mentioned. So correspondingly, our fourth recommendation is that capital markets and banking must continue implementing the shift towards green finance. While the landscape focuses on primary infrastructure investment, overall financial markets are extremely important within the climate finance ecosystem. Banks and other lenders greatly influence climate outcomes through loans and underwriting services. Their wider portfolios must be considered in assessing progress to the transition to a greener economy. And we're seeing more integration of climate considerations into business models, strategies, and policies. And that includes initiatives to measure, disclose, manage, and mitigate climate risks, such as the Task Force for Climate-Related Financial Disclosures. Consistent, widespread disclosure across all sectors is needed urgently. When achieved, it will permit analysis of the overall climate alignment of financial markets. In the meantime, asset-level investment tracking and climate risk assessment tools can help create methods to map climate-aligned finance at scale. And fifth, public institutions in particular need to make every dollar count, ensuring quality as well as quantity of climate finance flows. So there's actually still a lack of appropriate resources and methods to evaluate the effectiveness of the climate investments we're tracking here. And better information will guide public finance towards more transformative uses, aimed at unlocking other pools of capital instead of crowding out private investors. Improvement in that area will require a collaborative approach and have to involve a wide range of actors and communities. So in that light, our final recommendation is for the climate finance tracking community to anticipate and adapt to these changes to promote a rapid transition. Because achieving alignment with the Paris Agreement will require new definitions, frameworks, and methodologies so that we can understand which financial flows are consistent with the agreement's goals and which are not. And as mentioned, CPI partners with and helps to convene stakeholders in the tracking community to pool resources, link areas of expertise so that we can tackle these issues. So before we go to questions, we'd also like to share with you some of our related publications. Please visit CPI's website for more information on these. Apologies for the slight confusion there. But all three mentioned here. And we're also we've recently published Energy Access Landscape with SE for All. And early next year we'll have a renewable energy sector landscape with IRENA. Next year we'll contribute to the 2020 biennial assessment with the UNFCCC. And we also have forthcoming national landscapes for Kenya, India, and Indonesia. So thank you very much, and I'll hand back to our host, Caroline.
We will now take a minute or two to collect questions. As a reminder, you can type your questions in the chat box in the lower right-hand corner of your screen.
You want me to answer that?
had quite a few questions come through, so we're going to get started. We've had quite a bit of questions on adaptation, including why is it lagging behind? Do we have a sense of private equity versus venture capital flows into adaptation? Is that data currently included in the landscape? And also, what reasonable percentage of climate finance should be allocated toward civil society protecting their portfolios of shareholders toward adaptation and resilience? Xavi, do you have any thoughts on those?
Yes, couple of thoughts here. Like, despite adaptation finance, which rose significantly from the previous years to 30 billion right now, there's still a substantial gap that exists when we are looking at a number of 180 billion per year. That's the need that we are looking at. Also, this I did find more balanced allocation of funds across adaptation sectors as well, like with with water projects and equally distributed in water projects, land use and disaster risk mitigation. However, it's very important to note that it only represents a very partial estimate, and particularly in regard to the private sector as well. This is primarily due to several reasons that we encounter. Firstly, due to definition challenges, which is difficulty in kind of distinguishing between the sort of adaptation investments from general flows or broader risk management. There also, an absence of universally accepted impact matrix, which result in limited data availability. And this more like a dynamic problem, with impacts, climate impact and scenarios keep changing constantly and with no agreed baselines to adapt from or future scenarios to adapt to. And also, we also see data that we capture is, difficult to assess the context dependency, which is often, confidential. However, we at the same time do acknowledge, there are efforts underway to kind of improve these methodologies and, filling these gaps, as evidenced by the common principle developed by MDBs and amongst others. So yes, there's a lot needs to be done on the adaptation side, but also, there are always different business opportunities that also exist under adaptation. For instance, under the CPI Global Innovation Lab, we have the Climate Resilience and Adaptation Finance and Technology Transfer Facility, which is called the CRAFT, an acronym. It's a first of its kind equity, which is targeting companies providing technologies and solutions for climate adaptation and resilience in sectors like coal, supply chain options, and water disposal. So yes, definitely there's a lot needs to be done to fill the gap for the adaptation related investments.
Great, thank you, Xavi. We've gotten also quite a few questions about our methodology. Rob, would you be able to answer those?
Sure thing. Hi. Yeah, thanks everyone for such great questions. So I'm seeing several that are related here. I'll try to address as many as possible. Firstly, the data that we're tracking in the landscape, a question about whether it's pledges or actual disbursements. So yeah, very much we're tracking commitments made prior to the date of financial close of a project, or dependent on the data source, but making sure that it's always primary investment going straight into the infrastructure that's being built. It's extremely messy to try and track disbursements, and the data is often confidential or not available, so that's why these are commitments instead of disbursements. And there's a couple of questions about private sector investment. So with regard to the data gaps and data barriers, that's particularly pronounced when it comes to the private sector. As Xavi was just talking about with adaptation, that's a major challenge. But because private data sources are so often confidential, but not only confidentiality, issues that we face are that it's quite burdensome for actors investing in climate finance to disclose the various factors that are relevant when it comes to climate considerations. Sorry, excuse me. It's quite burdensome for private actors to make these disclosures, and in terms of information, as well as accessing a consistent benchmark and being able to judge. So that's a reason we see an issue there. I'm seeing a question about green investment taxonomy. So we try and make reference to we align our working definition of climate finance with the UNFCCC Standing Committee on Finance, and that's why we link it to primary capital flows directed to low carbon and climate resilient development. But we also draw on members of the OECD's Development Assistance Committee data, group of multilateral development banks, and members of the IDFC reporting on climate finance, as well as multilateral climate funds. And we acknowledge that there are lots of different emerging alternative standards, definitions, and classifications. For example, at the moment, the EU taxonomy on green finance is extremely important in this space. But because these are so emergent and still under development, they're not currently reflected in the landscape. And that sort of really indicates how a taxonomy needs to be really consistently and widely adopted for it to be useful in order to measure these flows. And when it comes to impact, that's the standards of information are even higher and often context dependent, especially when it comes to adaptation. So yes, in short, there's lots that can be done by reaching these common definitions, but there's still quite a way to go.
Thank you, Rob. We've also had quite a few questions on mitigation, including, can you explain the U.S. $612 billion in 2017 to U.S. $546 billion in 2018? And again, there was quite a few other questions on mitigation. So Cooper, if you could answer those, that would be great.
Sure, absolutely. So the first thing to note when we look at this drop from 2017 to 2018 is this sort of inter-year fluctuation is a big reason that we actually use two-year averages to show sort of a smoother upward trend. A lot of contributors to some of these inter-year drops, which we actually have seen at certain points in the past as well, are things like investment lag, time from when finance is approved to when shovels go in the ground for a project, or even a lag in being able to track what projects are getting underway. So that may be part of the story there. An additional factor is that we saw some unusually high spending in certain areas, especially from development finance institutions in 2017. There were some internal policy changes for a lot of governments and development finance institutions, kind of changing the focus of what green finance looked like from 2017 to 2018. And with that, there was an adjustment and a slightly reduced investment from those institutions the following year. So I'm actually going to move into a couple more mitigation-related questions that have come in here. There's one question asking about the growth in transportation spending and sort of a shift away from renewables and energy efficiency spending. I want to point out that trend is specific to public finance. So renewable energy investment is still much greater in the private sector. The public sector investment we have seen trending towards low carbon transport solutions. And a big reason for that is when the private sector is funding renewable energy so extensively and well-developed markets exist for renewables in a lot of places, there's sort of a next priority up mentality among governments and development finance institutions that it makes sense when a private market can support renewables to maybe move away from some of those renewable subsidies and policy regimes and towards supporting other priorities for sustainable development, like low carbon transport, like energy efficiency, that need more market development and more capacity building around them before the private sector can then begin to flow finance in at rates similar to what we've seen in the past with renewable energy. And then one more question regarding how much the investment gap would shift if all existing fossil fuel finance were shifted to Paris-compatible energy investments. So that's a great question. We've identified, based on the IEA data that we pulled, we've identified about $800 billion in annual fossil fuel infrastructure finance. So given that we have this about half a trillion dollar figure for total climate finance average over 2017, 2018, you add that $800 billion on there, that more than doubles current climate finance. It comes out to a total of $1.3 trillion, which gets us down just below the low end of that $1.6 to $3.8 trillion annual investment that IPCC has estimated would be required to completely green the energy sector going forward. So the basic answer is it gets us a lot of the way there. It's very important to reduce fossil fuel investments and convert that to investment in green technologies. At the same time, there's still a need to scale up investment beyond just flipping those existing fossil fuel financing to Paris-compatible energy investments.
Thank you, Cooper. Our next question is, how important is integrating international climate funding into the national budgets? And what are the key issues in this area? Chavi, do you have any thoughts on that?
Yes, tracking domestic climate finance and country level data is very important and often really offers an opportunity for government to mobilize and plan resources by identifying where the funding gaps are at national or subnational levels and better align their finance to their domestic level climate policy objectives. But we gather data from several databases and it often lacks granularity across those databases. We have we sometimes get country level or regional level data that makes us difficult to do in country level analysis. Also, data limitations kind of prevent us doing a full accounting of public budgets that are dedicated to domestic climate action. So in particular, we're looking at domestic public procurement or infrastructure investments and even government shares in state-owned enterprises and enterprise investments. But that being said, CPI has been supporting governments of Brazil, Indonesia, India, and Kenya in doing domestic, actually national level climate finance tracking. And this work really builds on what we have done in Germany, Indonesia, and Cote d'Ivoire. So yes, these really offers us an opportunity to kind of track this data better at the national level.
So we've also gotten some questions on instruments, including what's the difference between balance sheet and project debt, and how does market rate debt count as climate finance? Cooper, do you have any thoughts on those?
Yeah, sure. So the difference between balance sheet and project level debt is basically a function of how companies are accounting when they're setting up a project. So when you set up a special project vehicle, you're basically creating a corporation unto itself that has its own credit that can lend and borrow on its own. And that project level financing is structured a little bit differently in an accounting sense than when a company just uses their overall credit to borrow on their corporate balance sheet, and then they can funnel that to a project. So specifically, project level financing is basically borrowing and lending based on the revenues and the creditworthiness of a single project, as opposed to the creditworthiness and the revenues of an entire corporation. Okay, so in terms of the other question about why or how does market rate debt count as climate finance since it involves repayment? So our definition of climate finance is essentially any kind of financial instrument that's dispersed that's going towards climate smart, sustainable investment. And so that's a pretty broad definition, but we want to all of the ways that money is flowing towards these types of investments. So, I see, since it involves repayment, well, the way that we define finance, again, it could be debt, it could be equity, it could be grants. All of these are strategies that are mobilizing green capital, whether they're at market rate or whether they're at concessional terms. They're all moving us towards these sustainable.
Questions on renewable energy and why that amount is so large. Rob, can you address those, please?
Sure thing, thanks. Yeah, so it's an unfortunate fact that we do see an enormous amount of money flowing to renewable energy compared to these other sectors that are also in dire need. It must be said that some of this is to do with is an artifact of the kind of data sources that we're drawing on, but it's nowhere near all to do with the methodology. And in fact, renewable energy has just had a much longer track record of demonstrating some positive returns for investors, and has had a lot of, in fact, decades of kind of established support from public institutions, both in terms of the kind of enabling policy environment, but also catalyzing investments. But on the flip side, that kind of demonstrates the potential for other sectors to undergo the same transformation if they were given the same levels of support and kind of coordinated investment from both public and private actors. Energy efficiency is a tough one because we're sometimes asked about a much larger figure for energy efficiency investment, which is provided by the IEA. But again, it's a sector where methodology is extremely important, and you could consider energy efficiency investment to be people buying relatively energy efficient goods and infrastructure compared to the sort of dirtier alternative. And if you do that, then you can reach quite a high number. But that's quite a difficult and tricky method because it again relies on there being sufficient sort of improvement above a baseline for efficiency standards, and that baseline is often not really quite established given transition scenarios, and there are information gaps where actors are simply not referring to that baseline, and so we underestimate energy efficiency. Not underestimate, we're more conservative with our energy efficiency estimates. But really, we're hopeful to see some massively sort of upscaled investments in that sector, but as well as in the transport sector. Should we start to see the kind of public policy frameworks and catalyzing investments coming in?
Thank you. We also had a comment that it's disappointing to see the low levels of finance flowing to sub-Saharan Africa. Cooper, do you know why this remains to be the case?
Yeah, sure. I'll just say I definitely agree with that. It is disappointing to see these levels of finance flowing to sub-Saharan Africa, especially given that so many of the countries in that region are identified as being especially vulnerable to climate threats, as we see increased severe weather events and disasters and things of that nature. So I think that the big story here is this is pretty consistent across a lot of developing countries, including those in sub-Saharan Africa, is just that they're very dependent on public finance, and public finance is only part of the story. So we've seen in other markets, in China, in the Americas, specifically North America and Chile, that there is a lot of interest in renewable energy, and that's really what drives private sector investment, maybe to an extent sustainable transport as well. But in countries that have less well-developed markets, where institutions are perceived to be as less stable, where there is more risk for investors, there's not as good of a chance of attracting private sector spending, and that's a huge component of the climate finance that can be brought to bear in those places. So the approach there is basically to have local governments and development finance institutions partner with private finance to bring in private capital and basically pioneer new markets for sustainable development in those places that don't currently exist. But as you can see from the numbers that were cited about flows to sub-Saharan Africa, that's still very much a work in progress and something that we hope will increase in future years.
Cooper. There's also been several questions about whether or not the slides and the presentation will be available, and yes, we'll have those on our website in the coming days, and they'll also be emailed to all participants. You can also find links to all of our work that was mentioned on our website, and I can also post the link to that in the chat box as well. We're just about at time, so we wanted to just wrap up with some final messages from Barbara. We had a question on what are the implications of your report for the upcoming negotiations in Madrid, and also what's the key message when comparing the 2019 global landscape with its predecessor?
Great. So thank you so much, Caroline and team, and thank you so much to everyone on the line here for a set of really excellent questions. And certainly, I do see this today, the beginning of a longer conversation where we, want to try to help shed more light on what's happening and how can we use this report to really scale up investments. Just like, what is the main message, I guess, compared to the last reports that we had on this matter. I think there is a positive message in the sense of there is a continuous positive trend on increases in climate finance. I think particularly positive is the fact that climate finance is increasing across all investor groups, particularly from some of the more mainstream investors, including institutional investors, which I think is something which certainly is promising, because we all know that if we want to close the investment gap, then we do need to bring, basically climate into the into the mainstream, and we really need to make sure that all investments are being considered through a finance lens. But I think the main message this time remains from the last time, maybe it's even stronger than the last time, is that while we do see this positive trend, we are falling far short of what is needed. And we are slowly running out of time, particularly in light of the increases in investments into fossil fuel activities. So I think, what does that mean for Madrid? I think we certainly hope that we can use our report here to say that business as usual is not an option. We do want to raise awareness and ambition and make sure that we really focus on, using the positive trends that we've seen in order to go one step further and helping focus basically the negotiations there, but more that the broader awareness and discussions and work from all the various groups and civil society groups on how can we really help align all financial flows with the ultimate 1.5 degrees temperature target, and what is needed in order to make, to turn the overarching, commitment and the increasing awareness around climate change into concrete action implementation. So I think we will try to do what we can and to make sure that we at least, say that increasing climate finance commitment alone is not enough. It is obviously an essential part, and it needs to continue, but it is more crucial than ever to phase out investment in the fossil fuel supply chain and other harmful activities, and that is something that we really need to, call for stronger than ever. So I think I'll probably leave it there for now. I do hope that I will see many of you in Madrid, and we will have a number of events, and I encourage you to reach out to us afterwards as well to clarify further questions and let us know how we can help really create the baseline that really we can all use to call for further action. So, Caroline, back to you.
Thank you very much, Barbara, and thank you also to our presenters, Cooper, Rob, and Xavi. This concludes our webinar, and thanks for your attention. For more information, you can download the full Global Landscape of Climate Finance 2019 report on our website at the link I've provided in the chat box. If we weren't able to get to your question today, please feel free to reach out to me through the email address that I've also provided. It might also be of interest to you that the Global Innovation Lab for Climate Finance is holding an open call for ideas for financial instruments that can unlock investment to tackle some of the most difficult climate and sustainable development challenges. I will post the link to submit an idea in the chat box today. Thank you and have a great day.